Welcome back to Peaceful Investor. If you're new here, we don't chase the green candles or buy into the firmer. We focus on long-term investing, finding great businesses at the right price and holding them until the story changes. My name is Ricky and today we are talking about a stock that has been all over my radar lately. But before we get into the charts and the numbers, here is the necessary disclaimer. The content is in this video is only for informational purpose and not a financial advice. I'm sharing my personal journey, but you must always do your own research before investing your capital. As many of you know, I love the restaurant industry. It's a sector I understand. I can go to the locations, taste the food, and see the foot traffic with my own eyes. But being restaurant investor requires a lot of discipline. A while back, I was invested in Portillo's. I love the concept, but I eventually had to sell. Why? Because the fundamentals become saturated. The growth wasn't hitting the same way. And the expansion outside of Chicago started to feel a bit stretched. It wasn't a peaceful hold anymore. Then I moved into Kava. That was a great win for this channel. Kava gave me a solid profit and the brand is incredible. However, it recently got very expensive. The valuation climbed so high that the risk outweighed the reward for a long-term investor. So I decided to take my profit and move on. This brings me to the next potential play I have been researching. First Watch. First Watch is the leader in daytime dining. They only serve breakfast, brunch, and lunch, which is a very efficient model. I have been looking at their Q3 2025 financial highlights, and here is a lot of like here. First, let's talk about revenue. They reported 316 million for the quarter, which is a massive 25.6% increase year over year. That is a huge growth rate for a restaurant chain. But the metric I care about most is same store traffic. While most casual dining chains are struggling to get people through the door, First Watch actually saw their traffic grow by 2.6%. People are choosing this brand over others, even in a tough economy. They opened 21 new restaurants just in Q3, bringing their total of 600 locations. And here is the kicker. Their restaurant level operating profit margin improved to 19.7% compared to last year. They are becoming most profitable as they grow, which is exactly what we want to see. The risks, debt and accounting material weakness. So if the growth is so strong, why haven't I bought in yet? As a peaceful investor, I look for the cracks in the foundation. The biggest concern right now is debt. First Watch has taken on over 264 million in debt to fund their rapid expansion and buy back franchisee locations. In a world where interest rates are still a factor, that debt is expensive. It's the reason their net income was only 3 million this quarter despite making 316 million in sales. There is also a yellow flag in their filings. They admitted to a material weakness in their internal accounting controls. Now they have hired a new leadership team to fix this, but for me that creates uncertainty. I want to see the back office as clean as front of the house because I put my name onto the shareholder list. Because of that debt and the accounting questions, I am staying on the sidelines for now. I am waiting for next quarter reports in the Q4 and the full report 2025 results, which are expected on March 10th. I want to see if they can maintain the 2.6% traffic growth during the holiday season, and more importantly, if they can show a clear plan to pay down the debt. If the Q4 report shows they are tightening the ship, FWRG could be the next big long-term hold. But I want to know, what do you think? Is the growth worth the debt risk, or are you waiting for the sidelines with me? What do you think? Let me know in the comments. If you found this analysis helpful, please hit the like button and subscribe to The Peaceful Investor. And I will see you in my next video. Thank you.